Good morning. Thank you for joining today's daily webinar where we go over your questions and then we also go over certain topics. Today's topic is surrounding opening a solo 401k plan and learning what to watch for before you open a solo 401k plan. As always, you can follow the conversation on our community site, which is mysolo401k.net/my-community, where we have over 30,000 members. We're constantly responding to forum posts. There's also a large video library out there and a whole section of guest blog posts from other professionals in the industry, such as financial advisors, attorneys, and CPAs, where they post constantly out there on our community. So take a look at those host blog posts as well, and feel free to also create your own blog and start posting away. All right, let me share my screen here. Give me a moment here. Okay, let's take a look at a quick question here before we get started. We've got a question here from Chandra. Is there a maximum that can be reported on a 1099-R per year? So the form 1099-R is used for reporting items like distributions, whether taxable or not, as well as conversions, whether in-plan pre-tax conversions from the pre-tax solo 401k to the Roth solo 401k to the mega backdoor Roth solo 401k conversion, where you make a voluntary after-tax solo 401k contribution and convert it to the Roth solo 401k or the Roth IRA. So there's no limit with regards to what gets reported. What drives the reporting amount on that Form 1099-R deals with the amount of distribution that you process, as well as the amount of funds that you convert. For instance, if you want to do the mega backdoor Roth solo 401k conversion, you can't go over the annual contribution limit, known as the overall limit, which is $69,000 for 2024 and $70,000 for 2025. If you're processing an in-plan conversion of pre-tax solo 401k funds, however, let's say you have a few $100,000 in the plan and you want to convert all those to the Roth solo 401k, there's no limit either. So the Form 1099-R doesn't necessarily put limits. It's used to report the amount that's actually distributed or converted. Okay, well, it looks like you've got a follow-up question here. So yeah, if you want to convert funds from the voluntary after-tax solo 401k to the Roth solo 401k or to a Roth IRA, then the annual contribution limit, as I touched on already, for 2024 is $69,000, and for 2025 is $70,000. And then that would get converted to the Roth solo 401k. So that would be your maximum amount that you could contribute, known as the overall limit, as a voluntary after-tax solo 401k contribution. Okay, today's webinar and Q&A session is for informational purposes. We're not providing investment advice, legal advice. We don't sell investments. So now that we have that out of the way, let's get started here with our presentation here, and we'll keep answering questions as they come up here on the live chat. So don't hesitate to continue to post your live questions. Okay, let's see here. Let's start here by understanding why you should listen to this webinar before you decide to open a solo 401k plan. So what do you need to know first? Well, number one, you still have time to open a solo 401k plan for 2024. So even though we're here in February in 2025, you can still open a solo 401k plan that's effective for tax year 2024. So that's something that many brokerage firms may not allow you to do if you open a solo 401k with them. But if you open it with us, that's an option. Why? Because the regulations allow for it. And there's also enhanced features with the solo 401k that we offer, known as a self-directed solo 401k plan. You can, for instance, get an auto contribution credit amount of $1,500, which we'll talk about more here in a little bit. That's where the government is essentially subsidizing your retirement account, the costs of your retirement account, for several years. So essentially the government wants the self-employed community to save for retirement, and that's why the IRS or Congress allows for the auto contribution credit of $1,500. And again, we'll talk about that more here shortly. Now, let's talk about the critical deadline information for 2024 for opening a solo 401k plan and for contributions as well. So for instance, if you're a sole proprietorship or a single member LLC or a contractor where you file a Schedule C, you can still open a solo 401k plan for 2024, and you're going to be able to fund that plan for 2024 here in 2025 by your business tax return due date plus timely filed extension. So the employee contribution, for instance, which is that $23,000 limit for 2024, if you're a sole proprietorship and you open a solo 401k here in 2025, you can make employee contributions by April 15 of 2025 for 2024. And if you also open it here in 2025, you're going to be able to make voluntary after-tax solo 401k contributions and employer profit-sharing contributions by April 15, or if you file for an extension, by October 15 of 2025. And these are 2024 contributions. We have a good page here on our website that goes over the, let me see if I can share that page with you here. That goes over the, what I'm talking about here, about the extended time for a sole proprietorship to open a solo 401k plan and make all these different contribution types. Let me share that screen with you here. Let's see here. So here it is. This is the specific page I'm referring to about, oh, that's the wrong one. Go back to it here. Okay, here's the specific page regarding sole proprietorships, regarding how you can still open a solo 401k plan for a solo 401k in 2025, and you can still make contributions, all the contribution types here in 2025. So this here talks about the various contribution deadlines for an LLC tax as a sole proprietorship, or if you file a Schedule C if you're a contractor, for instance. So this is a good page here to take a look at. Let's go back to the main page we were discussing here. Let's see here. Okay, so back to this page here. Now that's for a sole proprietorship or single member LLCs or contractors. Just look at other business types such as an S corporation, C corporation, and partnership. You can still open a solo 401k plan here in 2025 for 2024, and you're going to be able to make employer profit sharing contributions as well as voluntary after tax solo 401k contributions by your business tax return due date plus extension here in 2025 for 2024. So that would be until, for an S Corp and partnership, you would have until March 15 of this year to make 2024 contributions. If you file a business tax return extension, the extended deadline would be to September 15 for both the S Corp and the partnership. If it's a C Corporation, it would be April 15 or in the extended deadline of October 15. Okay, so let's talk about the basic solo 401k that's offered by typical brokerage firms like Fidelity and Schwab or T. Rowe Price versus one that's self-directed from a company like my solo 401k Financial. So one offered by a traditional brokerage firm, it's going to be very basic in that you're only going to be able to invest in equities. So you won't be able to invest in alternative investments like cryptocurrency, real estate, notes, and so forth. You also won't be able to do voluntary after-tax solo 401k contributions. You'll be able to do pre-tax solo 401k contributions, but not voluntary after-tax solo 401k contributions. They also don't allow for participant loans, whereas the solo 401k offered by my solo 401k Financial does allow for participant loans where you can borrow 50% of your solo 401k balance, not to exceed $50,000, and you pay back your own solo 401k. So with the enhanced features of a self-directed solo 401k from a company like my solo 401k Financial, as I touched on already, you can invest in alternative investments like real estate, private equity, precious metals, cryptocurrency. You can also perform the mega backdoor Roth solo 401k strategy, where you make a voluntary after-tax solo 401k contribution, and then you subsequently convert that over to the Roth solo 401k or the Roth IRA. So that's one of the enhanced features of a self-directed 401k from a company such as my solo 401k Financial. What is more, you're also going to be able to do high contribution amounts. There's a way that you can possibly get all the way up to $81,250 in contributions for tax year 2025 with the self-directed solo 401k from a company like my solo 401k Financial. That's known as the super catch-up contribution, where you get up to that $81,250 amount. Let's talk about that catch-up contribution here for a moment. Let me share another screen here with you, and we'll talk about the super catch-up for a moment. Okay, here's information regarding the super catch-up contribution. So that's how you're able to get up to $81,250 in contributions for tax year 2025. So with the super catch-up contribution, it's a catch-up contribution available for those who are a certain age. Specifically, those who are age 60, 61, 62, or 63 in 2025. So for 2025, if you fall within that age category, you can make a catch-up contribution of $11,250 instead of the $7,500 typical catch-up contribution. And as a result, when you add that to the overall contribution limit of $70,000 for 2025, you can end up contributing a total of $81,250 to your solo 401k plan. For example, you can make the $70,000 contribution to the voluntary after-tax solo 401k bucket, and then convert that to the Roth solo 401k or Roth IRA. And then if you fall within the age category here, you can make an additional $11,250 contribution to the employee Roth solo 401k bucket. So it cannot go to the voluntary after-tax bucket, but it would go directly into the Roth solo 401k bucket. So that's a way to really supercharge your retirement savings, especially on a Roth basis. Okay, let's take a look at some more questions here, and then we'll continue with our presentation here. Let's see here. We've got a question here from another one here. I have contributed my full allowable amount to my after-tax for 2024. I did not convert until my after-tax until January of 2025. That's okay, because you can, since you converted it here in 2025, it's still going to be a non-taxable conversion. So that's why the contribution rules are different than the conversion rules from a deadline perspective. So from a contribution perspective, if you make a voluntary after-tax solo 401k contribution in 2025 for 2024 and then convert it here in 2025, it'll count as a 2024 contribution, but it'll count as a 2025 conversion, because conversions are reported in the year that the funds are actually converted. Nonetheless, you're still going to be able to make a 2025 voluntary after-tax solo 401k contribution as well, and you can make that here in 2025, which would be that $70,000 amount, or you can wait and do it in 2026 by your business tax return due date plus timely file extension. If you make it here in 2025, then you can also convert that here in 2025 as well. So therefore, you will have converted two amounts in 2025. That is your 2024 voluntary after-tax solo 401k contribution, and then your 2025 voluntary after-tax solo 401k contribution, which is fine, but still within the within the regulations, because again, the conversion deadline is different than the contribution deadline. All right, great question. Continue asking questions here in the live chat as we continue to go over our presentation here. So let's flip back to our other presentation, or to the other screen here that we were talking about here. Give me a moment here. Let's look at the, okay, let's pick up here where we left off. So we're talking here about why you should wait to open a solo 401k plan until you listen to this presentation, because of the enhanced features that we've been discussing here that apply to a self-directed solo 401k plan offered by a company like my solo 401k Financial versus a solo 401k plan offered by a traditional brokerage firm or a bank like Wells Fargo or Chase Bank, for instance. So back to what we were discussing here. So we talked about how the enhanced self-directed solo 401k allows for the mega backdoor Roth solo 401k, how you can make contributions. We talked about the solo 401k participant loan. So with an enhanced solo 401k plan from a provider like my solo 401k Financial, you can borrow from your own funds. And if both spouses are participating in the plan, because they both work under the same self-employed business, each spouse can borrow from their respective solo 401k funds. So each spouse can borrow $50,000 or 50% of the total balance of their respective solo 401k, not to exceed $50,000. So for example, let's say spouse one has $100,000 in their solo 401k plan. They can borrow $50,000. Let's say spouse two has $60,000 in their solo 401k portion. They can borrow $30,000. So 50% of the $60,000 will be $30,000. And you're paying yourself back with interest. And the interest is typically prime rate plus 1%. The interest and principal flows back to your own solo 401k plan. There's no credit check. The solo 401k loan documents are generally prepared within a day or two, and then you'll be able to process the loan. The payments can be made monthly or quarterly, and you can borrow for 5 years for any purpose. If you use the funds for the purchase of a primary residence or towards the purchase, then you can extend that loan period from 5 years to 15 years or even 30 years. Now, another advantage about a self-directed solo 401k plan over a typical solo 401k plan offered by a brokerage firm is that a plan for my solo 401k financial has that auto contribution credit where you're going to be able to deduct $500 per year up to $1,500 over a 3-year period for having a solo 401k plan. Let's talk about that auto contribution credit here for a moment here. Let me share my screen on that. Give me a moment here. So here's the auto contribution credit. So if you open a solo 401k plan in 2025, you're going to qualify for this $1,500 credit. It's also available to existing solo 401k plans. So let's say you already have a solo 401k plan with another provider or someone like a Census or Equity Trust or other providers out there, or even traditional brokerage firms like E-Trade, Schwab, or Fidelity. That existing solo 401k plan can be restated to a solo 401k plan from my solo 401k financial, and you're going to be able to start taking advantage of a $500 credit in 2025, and then another $500 in 2026, and a final $500 increment in 2027. So with these auto contribution credits, the cost to set up a solo 401k is ultimately free because it's going to cover the costs of having a solo 401k plan for 7 years. And what's great about it is that it's a dollar for dollar tax credit, so it reduces your taxable income dollar for dollar. And you're not required to contribute to the solo 401k plan. So even though it's called the auto contribution credit, that doesn't mean you have to contribute to the solo 401k plan in order to take advantage of it. You just have to make sure that the plan has that feature built into it and that there are certain additional forms that you sign off on. And then you'll still be able to contribute in any amount that you wish, up to the overall limit, of course, which is $69,000 for 2024 and $70,000 for 2025. And you're going to use Form 8881 to claim that credit each year. So, for example, for 2025 tax year, you would file that Form 8881 to claim that $500 first year credit. Then you would file another Form 8881 in 2026 to claim the additional $500, and a final Form 8881 would be filed in 2027 to claim that final $500 amount for a total of $1,500. And if you're an existing solo 401k client where you opened the plan with this prior to the middle of December of 2023, we can add this feature to your plan as well as have you sign the applicable amendments, and you would be able to start taking advantage of this credit as well for 2025, 2026, and 2027. All right, let's take a look at a few more questions here, and then we'll go over a few more items. So we've got a question here. I contributed a full allowed amount of my after-tax account. I did not convert my after-tax for 2024 until January 2025. So that's fine. You can do that. That conversion would be reported as occurring in 2025, but you made the contribution for 2024, and the rules allow you to make contributions for 2024 and 2025. That's voluntary after-tax solo 401k contributions, for example. And then the conversion will be reported as occurring in 2025. And then you can also make another 2025 voluntary after-tax solo 401k contribution and then convert it to the Roth solo 401k or the Roth IRA. Okay, let's talk about a few more items here. Let's take a look at the eligibility requirements. So in order to open a solo 401k plan, you have to be self-employed. So self-employed means that you are an owner employee in your business and you're performing material services. You also cannot employ any non-owner full-time W-2 employees who work 1,000 hours or more. Now your spouse can participate in the plan as long as he or she is also working in the business. Here's an example of a one participant solo 401k plan. As you can see, there are 3 holding accounts. So you've got a pre-tax Roth and voluntary after-tax. You're required to have separate holding accounts, that is bank or brokerage accounts, to hold the different sources under the solo 401k plan. So for example, if you're a sole proprietorship or an LLC as taxed as a sole proprietorship, you can open a solo 401k plan here in 2025 to 2024, and you're going to be able to make all these contribution types for 2024. So you can choose, for example, to make the entire 2024 solo 401k contribution overall limit of $69,000. You can make that to the voluntary after-tax solo 401k bucket. You can do that by April 15 of 2025, or if you file for an extension, you're going to have until October 15 of 2025, and then you would turn around and convert that to the Roth Solo 401k plan. And that's $69,000 for 2024. And then if you also have enough net self-employment income in 2025, you can do another contribution amount of $70,000 to the voluntary after-tax solo 401k bucket and then convert it to the Roth Solo 401k. Here's an example of a 2-participant plan. Let's say your self-employed business is taxed as an LLC. Or let's say it's an LLC taxed as an S corporation, and that both spouses are participating in the plan. So the plan would be sponsored by the limited liability company. Both spouses would be participants in the plan. So here there are a total of 6 holding accounts, that is bank or brokerage accounts, because there are 2 participants in the plan. So each participant is required to have separate holding accounts, aka bank or brokerage accounts, and for each source of funds. Hence why here it would be a total of 6 brokerage or bank accounts. So a pre-tax Roth and a voluntary after-tax for each participant. And then each would be able to maximize their contributions and then immediately do a conversion if they want, if they do a mega backdoor contribution, for instance. Okay, let's take a look at a few other items here. So we were talking earlier about how a self-directed solo 401k plan for my solo 401k financial is better than a typical solo 401k. And one of the main reasons we discussed was because of the mega backdoor Roth solo 401k. This slide here talks about the mega backdoor Roth solo 401k with respect to the steps involved in that mega backdoor Roth solo 401k. So here you would, this is someone who opens a solo 401k plan. So let's say you open one here in 2025 and you're looking to make contributions for 2024. So once you open that plan, you're going to have a separate bank or brokerage account under that plan to hold that voluntary after-tax solo 401k contribution. So you then make that voluntary after-tax solo 401k contribution, let's say $69,000 for 2024, and you make it here in 2025, which can be made in 2025 by your business tax return due date plus time you file extension for 2024. And then you go ahead and convert that to the Roth Solo 401k. So you can move it from the voluntary after-tax Solo 401k bucket to the Roth Solo 401k bucket For example, many of our clients will use Fidelity Investments to hold their solo 401k funds for the plan that we offer, using what Fidelity refers to as non-prototype investment-only brokerage accounts, which will help you open up. So with the plan for my solo 401k financial, you can use Fidelity to hold the solo 401k funds for the plan that we offer. So even though Fidelity also offers their own solo 401k, which does not allow for the mega backdoor, they do provide non-prototype investment-only brokerage accounts for a self-directed solo 401k plan offered by my solo 401k financial. And it's my solo 401k financial solo 401k plan that allows for the mega backdoor, hence why you can do this. And then once you convert that from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket, then you need to complete our online conversion form so we collect the necessary information to report that conversion, which is non-taxable, to the IRS by issuing Form 1099-R, which is the final step in the mega backdoor Roth solo 401k strategy. All right, let's take a look at one more slide, a couple more slides here, and then we'll be done with our presentation for today. So the advantages about opening a self-directed solo 401k from a company like my solo 401k financial is that we'll provide not only the ongoing plan document updates as required by the regulations for being the solo 401k provider, but we'll also cover any type of reporting for the plan, specifically Form 1099-R reporting and Form 5500 Easy reporting. And the 5500 Easy and Form 1099-R reporting is covered in our annual fee of $125. So in other words, we don't charge any additional fees for assisting with Form 1099-R and 5500 Easy reporting. It's important to note that in order for us to assist you with the Form 1099-R and Form 5500 Easy reporting, you need to communicate with us because we don't have access to your funds. So as the trustee of the solo 401k plan, it is your responsibility to reach out to us if you want us to assist you in preparing the Form 1099-R or the Form 5500 Easy. Let's talk about each of these forms for a minute. The Form 5500 Easy is an informational tax return that applies to a solo 401k plan once the market value of that solo 401k plan is greater than $250,000 as of the end of the plan year. For example, if you have a solo 401k plan already from my solo 401k financial, and the market value of that self-directed solo 401k plan was greater than $250,000 as of December 31st of 2024, then you want to reach out to us because a Form 5500 Easy will need to be prepared and filed with the IRS or the government by July 31st of this year, and we prepare and file that electronically for those clients who request that form on a timely basis. A little tidbit to understand here is that if you also have a defined benefit plan for your self-employed business and you also have a solo 401k plan, which means you have both, which is commonly referred to as a DBK in the industry, then from a Form 5500 Easy perspective, you're going to have to file two Form 5500 Easies, one for that defined benefit plan and a separate one for the solo 401k plan, because you have to aggregate the balance of that defined benefit plan and the solo 401k to determine if the market value between the two plans is greater than $250,000. If so, then that's going to trigger that Form 5500 Easy filing requirement. Now let's talk about the Form 1099-R. That form is used to report distributions from the plan, as well as conversions within the plan, as well as conversions out of the plan. So if you take a required minimum distribution or a hardship distribution or a regular distribution because you're age 59 and a half or older, or let's say you did a Roth solo 401k distribution and it was qualified, because you've had the Roth Solo 401k plan for both 5 years and you're age 59 and a half or older, those items are going to trigger the requirement to issue a Form 1099-R, which would be filed with the government. We take care of that reporting for those who kindly request it, and then we file those with the IRS by March 31st, and then we provide copies of those Form 1099-Rs to our clients by the end of February each year. That also applies to conversions, the mega backdoor conversion, for example, where you make a voluntary after-tax solo 401k contribution and then convert it to the Roth solo 401k or the Roth IRA. Even though that's not going to be a taxable event, it is going to be reportable on the Form 1099-R. All right, so those were the items I wanted to cover today. And looks like we don't have any more Q&A questions here this morning. Keep in mind, we're live every day at 10 a.m. Pacific time and at 1 p.m. Pacific time. So we'll be back here in a few hours at 1 p.m. Pacific time if you then have a chance to ask your questions today. Until then, make it a great morning.